Hello and welcome. Rahul, you're watching my YouTube channel Ragma Talk Show. And if you're watching me consistently, welcome back to my channel. See, whenever I come in front of you, I have a purpose. I want to instill positivity. And I want to disseminate some information that can be used by you. Because if you really want to change your life status, and if you really want to be financially independent, you have to start any activity. And what could be better than doing a business or having a better job. Or if you will be upskilling yourself each and every day, you can make your livelihood better and can find different opportunity all the time. It is essential in this time to have knowledge of businesses, how it runs, because whenever you will do a job of an organization event, you will play the same role. You will bring the resources for the companies, and company will make profit. So at the end of the day, you have to understand exactly how companies functions and how to make profit, how balance sheets work, how companies work, and how they make profit and how they pay you through their profits, because all these knowledge is important for each and everyone. And that is why I want you to know exactly how you can establish your own private companies, or if you want to take it to public limited companies, you can make it public, and how you can run a big business. Because starting from scratch is important, having knowledge is important, having ability to aspire to accumulate certain knowledge so that we can take a stand on that, and we can strive for better opportunities. So that is why it is essential, because I am a banker, and I know exactly that if I will have expertise, then only I can look into the balance sheet of other companies, and then I can ascertain what are the functioning of that big company, how it can make profit, how we can give credits, and credit analysis requires every kind of insight about that big company, and that is why it is essential to know every functioning of the companies when you dive into that, and having profound knowledge will be really beneficial for you. If you really want to start a private limited company, how can you start nowadays? How can you start? For private limited company, you need 2 shareholders and 2 directors minimum. There could be 2 shareholders and 2 directors. 2 partners, 2 shareholders will be as a partner. They come. But limited liability partnership is different, and limited liability company is different. And limited liability partnership, the only thing is that it is more closed. You cannot negotiate with other people. So you cannot, bring others investment. You cannot negotiate private people. With the only limited liability partnership, you have to have your own you will be the promoter of the limited liability partnership. That is what is the restriction. Otherwise, the role is limited in limited liability partnership as well, unlimited liability company as well. So 2 directors and 2 shareholders minimum. Maximum can be 200 shareholders in private limited company. How you can start your private limited company? Nowadays, many an integrated way has been facilitated by Ministry of Corporate Affairs. When you visit their site, you will see that they have given a very easy framework to register your company. For starting a company, you need something, and that is why they have facilitated different ways. First of all, you have to find unique name for your own company. You found 2 directors, you found 2 shareholders. Then you associated, you have drafted memorandum of association, article of association, how you will work, how much shares you will bring to the company, what will be the legalities in the company, what will be internal structures. These will be defined by memorandum of association and article of associations. For directors, you need directors identification numbers. For dean, you need digital signature certificate. So you register for digital signature certificate of directors, and then for you register in Ministry of Corporate Affairs, you on Spice A and Spice B, you will find unique name. You register for directors identification numbers, and when unique name is allotted to you, then section B will be executed. For that, you have to draft memorandum of association, article of associations. When you complete all this work, you need PAN and TAN. You know exactly why PAN and TAN is needed. PAN is for company's personal assessment of tax. PAN is needed, and when you will bring resources in your company, when tax on resources, will be levied, like you will bring employees, and when you will be given salary, employees will be given salary, you will deduct tax from there. For remitting that data, TAN is needed. On resources you need to remit taxes. So PAN and TAN is needed. That will be, you will get, everything is integrated. For employees, pension fund, you need to register for PF, for their insurance, state insurance, ESIC, that is called, you will get that. Everything is integrated, you can get it easily. And after filing certificate of incorporation, when you get that, you go to bank and give them your certificate of incorporation, your article of association and memorandum of association, board resolutions, and your PAN, and you give them PAN. They will open an account. Then after opening that account, when the shareholder will deposit as per MOA their money, in company's account, then you will file that statement again on that website, and you will get certificate of commencement of business. And here your business is a start. You are able to run your business. You own a private limited company along with certain shareholders. So what happened? You have started a private limited company, but knowing exactly how to run any activity, how to run any business is important. And for that, you need to have better understanding. What are the sources? What are the uses of fund? What are the sources of fund? There comes balance sheet in picture. How will you bring long-term sources? How will you bring short-term sources? Sources means liability. And how you'll use that to generate assets of the companies. That means uses. So when you come, but that comes in your mind, sources, that means capital. You have to bring capital, and that is why in memorandum of association you have talked about authorized capital. That means share capital. And partner shares has deposited that with money. That means share capital of promoters have come infused into the company. Now comes the, first of all, starting operations. When you start with operation, then you will think of scaling and profitability. So all these things are important to understand exactly how, exactly that if any business you will run, you will have a business cycle. You will bring raw material, then you will process that, then finished good will be generated, then you will give it to vendors for selling, as a debtor, and the debtor will sell those those finished goods, and thereafter it will generate cash, then they will give you back to you, those cash. So these are the business cycles. That is what happens. That is what you have to scale. When you bring more and more raw materials, when you process more and more finished good will be generated. Or you can do trading as well. You can bring materials, and you can, after certain margin, you will sell on different prices. You can do trading. Such kind of business activities. Business can be of different types. So I have to understand exactly everything about business. When you will talk about business, balance sheet, you'll understand exactly at the particular date what were the uses of the fund, what were the sources of the funds, exactly the picture of the business. First of all, in balance sheet, you will see that left side capital is there. Reserves and surplus is there. Long-term liability is there. Short-term liability is there. After, when you come asset side, you will see that fixed asset is there, which is called net block as well. And thereafter, non-current asset and current assets and the intangible assets. First of all, macroly, you understand exactly how balance sheet looks like. Then you understand exactly how the company's functions. Then you have to understand how cash flows happen, profit and loss statement. You have to understand exactly how profit will be made. But before that, you need capital for the company in order to scale up your business. How will you approach venture capitalists, angel investors? How will you approach private equity funds to leverage these funds to start more and more operations, to generate more and more sales, to bring more and more cash, to bring more and more profit? So what happens, when you establish your company, and you have started your operations, you have to approach different investors. If you really want to scale up, you have to negotiate. And private limited companies have very narrowed down. They cannot raise public money, but they can raise and negotiate with angel investor, private equity fund, and venture capitalists, or high net worth individuals. Privately, they can negotiate to invest in their companies, and that is why private equity, they invest their fund for 5 to 7 years in that very company, and they will make your company established. They will make your company to make profit. Their first agenda is that they will invest in your company, then they will make profit, and then they will try to exit through IPOs or to try to sell it to other private equity companies. That is what they do. Their main agenda is to leverage their funds, to use that fund and to make more and more profit in your business, to establish your business. That is what they will do. And there comes the picture, what are the IPOs when you bring it public limited, when you enlist your company into public, then the IPO will come. But before that, everyone concentrate on infusing money, infusing their own shares, infusing their own promoter share, as well as negotiating with certain investors, private equity fund or venture capitalists, how they will scale up their business. Because many promoters, they don't want to bring their companies enlisting, because what happens after enlisting, many audit will happen quarterly. You have to express everything, you have to disclose your financial statements each and every quarter. Many audit board will come, they will scrutinize, public scrutiny will happen when you bring it to public. But there are other many ways. If private equity fund will invest and they will make profit through your companies, they can also sell it to the other high net worth individuals or other private equity company. They can do that because they have paid up capital in your company. Initially, I have told authorized capital in memorandum of association you will define. Authorized capital is that the maximum capital a company can raise. And issued capital is that how much share you issue to personal shareholders, or when it is enlisted through IPOs, you issue that very capital. And the paid up capital is that how much capital shares has been subscribed. The money has been paid for shares. That is what is paid up capital. When they will invest in a business, operating cycle will execute, many production will happen, the sales will happen, you will make profit, and these private equity companies, will make profit along with that, because they have paid up capital, they have share capital in their companies, and as per their share, they will try to make profit. And when the liquidity will be low, they will try to enlist it. The promoters try to enlist it through IPOs. They will try to bring money, cash flows into the company. And what will happen if fresh IPO is there through authorized capital? Then the company capital will be infused, through shares, through IPOs. But if there are more OFS in that very IPO, offer for sale, that is already subscribed by the paid up capital by these private equity companies, the money will go in their hand because they have subscribed that very capital and they are selling that, they're creating a liquidity for themselves. Company balance sheet is not changing. Money is being infused, sale is being replaced, only the ownership is being replaced in case of OFS through IPOs. And that that money goes to pocket of those people, those private equity companies who have already subscribed through IPOs. That is what there are certain parts. There are certain parts in IPOs. One is fresh IPO, which is through authorized capital. Secondly is OFS, offer for sale, what is paid up capital of the private equities or angel investors or high net worth individuals who want to create liquidity for themselves, or you want to partial exit. That is what they do. If 50% of the shares in your hand, the promoter's hand, then it is private equity. It is still privately owned. Though it is enlisted, though it is publicly enlisted, but if 50% of share, is in the promoter's hand, privately owned company will be there. When the shares will dilute below 50%, then it will go public, publicly owned. Otherwise, even public limited companies could be privately owned, like Reliance, like Tata, TCS and Tata Sons and Tata Trust are running these companies. You have example of that. So all these things you have to understand exactly in order to establish your company. And once you understand exactly how this functions, even you can approach your bank. And if you are starting a private company, initially if you want, for working capital, for term loans, for fixed assets, for machineries to, proliferate productivity, you need to establish more and more machineries. You can raise funds from banks, you can raise funds from private equities, but they will look into your balance sheet. That is what is the essential component of that. How a loan assessment bank we creators, as creators we do. Either we can give term loan for creating, plant and machineries, or we can give working capital for the operation of the business, for working capital cycle. We have to infuse money through working capital. When we give term loan, we give it for fixed assets, that will create machineries. For that we evaluate debt service coverage ratio, DSCR. We evaluate fixed asset coverage ratio, FSCR. What is debt service coverage ratio? We actually see how much cash accruals company is generating, profit after tax plus depreciation. And then we add interest on loan on numerator, and in denominator we add principals and installment of interest of that very principal of loan. Then we see exactly the debt will be serviced by the profit or not, by the cash accruals or not. That is what we see. But the companies do. Then profit after tax, profit before tax, EBITDA, earning before tax, interest, and depreciation and amortization. These all things you have to know exactly what are these. Once you know balance sheet, once you know cash flows and profit and loss statement, you will have deep understanding exactly, operating cycles and all these things. When you understand exactly, you'll be able to define that. When we understand exactly that DSCR is okay, approx 1.75 or 1.5, then we see that cash accrual is more, and we can service, company can service the term loans, and for fixed asset security coverage, you have to see exactly, because generating that very asset, these are the securities for your term loan. So you have to see exactly how much margin is there, total repayment of loan, we will bring a denominator, and how much fixed asset is there. If it is more than 2:1, that is okay for that. So all these ratios for securing your loan, we have to look into that. And when we are trying to finance working capitals, we look after, interest service coverage ratio for that very working capital loan. For that, we look after profit again, but profit before tax, PBIT. We look after that, how much it can be serviced or not. Because if the interest of the working capital, will not be served, then it will become non-performing asset for the bank. So all these things we look into, and when you will have perspective to make your company big, you certainly assess all these things. Your mind will run, and once you will have deep insight about the companies, how it runs, how you can maintain its balance sheet. If you really want to infuse money in your capital or not, do you really want to make progress in your company? Do you want to keep it privately owned? Do you want to bring it on public platform? Because once you bring a privately owned company to public owned company, then dynamics changes altogether. It is all about more visibility, more credibility, of the company, rather than control. Because if you really want to take control, you have to be privately owned. You have to bring promoter shares more than 50% all the time. You have to take control, because at the end of the day, you have to understand exactly how management, how directors will be there. Once you enlist that, independent directors will come. A little bit management will change. More and more transparency will happen, and that is why banks favors publicly limited companies, because transparency is there. Everything, every balance sheet is disclosed each and every day, every quarter. And that is what is the reality of the every company. But if you really want to run your company in India, you would like to own privately, and you would like to bring better investors in your company through negotiations, through angel investors, through high net worth individuals, and that is what you have to sustain your companies. Core process is important, but beyond that, these knowledge are very important in order to understand exactly where you want to stand. Thank you for listening to me.